The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Finally, ladies and gentlemen, the day is here, the day of the Fed. Welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho and Arabile Gamede, and these are your headlines. So the S&P, in advance of that, hitting a fresh record as retail data actually underscores the resilience in the US consumer and the US economy, whilst the DoubleLine Capital boss Jeffrey Gundlach joins a growing list calling for a half-point Fed cut today.
The two-year Treasury is down at 3.6, and so the Fed needs to cut rates 150 pretty quickly, and I think they're going to start with 50 tomorrow.
Hezbollah blaming Israel and vowing retaliation after thousands of pagers explode across Lebanon simultaneously, killing at least 9 and injuring thousands more.
US authorities expand the approval of a key Novartis breast cancer drug, opening access to patients at earlier stages of the disease. We'll speak exclusively to Novartis CEO Wapner at 6:30 London time. Commerzbank reportedly weighs replacing CEO Manfred Knof before his term expires next year, with investors said to be seeking a new leader with a clear mandate to face up to Unicredit's advances.
Inflation watch. Sterling strengthens ahead of key inflation data as investors raise bets the Bank of England will cut rates at this week's meeting.
Look, I've been in and around this business for a long time. There's a lot of stuff I don't know. Really, genuinely. And I guess my inquisitive nature keeps me going. There is so much. I don't pretend I know all this stuff, but I've been around a few decades. So when our headline bite from one of the most eminent people on Wall Street, brilliant man, says what he says, I don't understand what he's talking about. Should we play the Jeffrey Gundlach side? Have you got it, guys?
The two-year Treasury is down at 3.6. And so the Fed needs to cut rates 150 pretty quickly. And I think they're going to start with 50 tomorrow.
Why, if the two-year Treasury is trading at 3.6%, does the Fed need to move really quickly to catch it up? Mr. Gundlach probably said something that explains that. But in that bite alone, I don't get it. Surely that means to me that actually the market's done the job that the Fed would do anyway. And actually there's less pressure on the Fed because money markets are so easy at the moment. So you can get your cheaper money. It's great for corporates, great for governments refinancing, great for consumers refinancing as well. But actually a lot of the hard work's already been done by the market, which is kind of the point I've been making for years. But equally so, I don't understand the direct correlation between the two-year Treasury trading at 3.6%, ergo the Fed needs to move to catch up. I don't get that.
There was a view that the bond market used to be signalling something down the track. And, last financial crisis, there used to be this view that the bond market was flagging up some sort of slowdown recession and then pricing the yield curve in that expectation. And I think this time around, they're sort of saying the same thing. Look, you've got a yield curve that is showing you that there's some sort of slowdown coming in the economy, that you need central bank policy to be reflecting that slowdown. So there is a view going into the meeting today that the Fed is behind the curve and quickly needs to catch up.
But the Fed's not behind the curve, is it? Did you see the retail sales? Have you seen the New York data this week as well? American consumers looking fine fettle.
One piece of data, and we saw those sales up with 0.1% versus expectations.
US unemployment's 4.2%. That is bang on historical lows, give or take a percent.
When it comes to the 3-month average, we are below 120,000 on the average jobs created stateside. So I think, and that is without revisions. So if we get more revisions, could we be below that number?
But if the market believes the Fed's going to cut 3 more times this year anyway, where's the stress? If the market believes it and the Fed language is there and the dot plot says we're going to cut and we're going to cut by I don't know, 250 basis points by the end of next year. Where's the stress? Why do we need to rush?
It's the old bus metaphor, isn't it? That the bus is pulled up at the bus stop, the Fed can simply just hop on, goes for the ride, all smooth, no one missed anything, perfect execution, versus the bus starting to take off and the Fed is not quite at the bus stop and the bus is accelerating away from the bus stop and then suddenly you're running to catch up. This is the view that some have on the labour market, that you're actually seeing this unwind in the labour market and it's accelerating. If the Fed is not on that bus, then it's behind the curve. That is the view for some market participants.
The S&P's at a record high. If that can't all just be on the expectation that the Fed's going to go for 50.
Do you think market participants always have it right?
No, I don't think market participants always have it right at all. I'm just saying to you, they seem to be pretty relaxed in the paddock on Wall Street.
Yeah, and is that a concern? So you've got interest rates where they are, the expectations around the Fed, whether it's 50 today, and is that pre-market positioning ahead of any rate cut? And interestingly enough, some of the areas that have been rallying have been banks this week, and the old story that we were told that if you see a reduction in interest rates, it should impact the profit margins for some of those banks.
We've established that's nonsense anyway. The NIMs widening on the way up means that banks more make money. NIMs tightening the way down means they lose more. We know that's nonsense because that's one-dimensional. When we make it three-dimensional with delinquencies and other liquidity issues in there, we know that that's nonsense. Anyway, look, I've got to talk a little bit while you get to the wall. But we've already had an argument about the retail sales, which I will genuinely go through in a little bit more detail. Because I thought, no stress there. Another bit of data that I don't know whether it moves the needle or not. But anyway, as we mentioned, these markets, absolutely fascinating, whether they got it right or wrong, Karen.
Indeed, and let's just take a look at that market reaction. As we say, there's been some appetite stateside. Keep in mind, some of that just fading by the finish, and you can see flat for the Dow and the S&P 500, despite the fact that was a record level on the S&P 500. The Nasdaq perched higher. Treasuries, a quick look at how we're shaping up on that board. 3.59 is what we're seeing on the 2-year. Excuse me, take a look at the dollar trade. As a result of that, you can see the dollar crosses this morning. Dollar, don't forget, has been declining going into some of the Fed decisions. And this morning, euro dollar perched stronger. We're 111 on that trade. Sterling dollar, that is a slightly weaker trade this morning, just softening up around the 131.5. Dollar yen 141, and you can see dollar Swissy, that is a slide of about 0.2%. Now, WTI Brent, clearly a lot of geopolitics. We were watching the events unfolding around Hezbollah yesterday in the Middle East around pages. Brent prices and WTI this morning, though, are falling back slightly despite fears of a broader conflict still and the potential for that in the Middle East. Gold prices down by about 0.1%. Again, fascinating as we count down to a Fed decision that may have yield implications for something that is a non-yielder out there on the markets. To the Asian markets and what we're witnessing, the overall picture looks like this. Patchy. We've got a slightly flat, slightly weaker trade on some of these individual markets. So it looks like a holding pattern to me. The one that's straying the most from the flat line is the Australian market, down by about 0.1%, Steve.
So as Karen and I have just pretty much explained, the market's got different views on the data and what the market should be extrapolating from that. As we just said, uncertainty is the word. US retail sales, they surprised to the upside in August, 10 basis points higher on, well, they did. But to be honest, Karen mentioned a bus. You could park a bus through the range. It was negative 0.6 to positive 0.6. But the median, it was a little bit higher. OK, so 10 basis points higher on the retail sales versus expectations of negative 0.2%. That comes on the back of actually a revised upward July figure, up 1.1%. My copy says a surge. I don't know if it was a surge. Anyway, the figure suggests the American consumer could well be, as Karen quite rightly pointed out, it's one swallow, doesn't necessarily make a summer, but the American consumer could be stronger than thought. Perhaps, who knows, weakening the case for a half-point cut from the Fed today. Money markets are still leaning towards a 50 basis point cut, according to the CME's Fed Watch tool. The CNBC's own Fed survey suggests today's move could be much smaller, with 84% of respondents saying they expect a quarter-point cut. Now, the difference widens as you look further ahead, with almost a full percentage point gap between where the market expects the Fed rate to sit by the end of next year and expectations of economists. But we get a dot plot today, hurrah! Expectations of economists, fund managers and strategists that we surveyed.
Bridgewater's Ray Dalio is on the side of the CNBC survey. He says a 25 basis point move, quote, would be the right thing to do if you look at the whole picture.
DoubleLine Capital's CEO, Jeffrey Gundlach, we may have already played his sound twice, but they're all fascinating, these people. They've all been there. They've all seen it. They've all done it. He's with the market. Take a listen to what he told CNBC about his expectations for today's meeting.
I'm sort of famous, and I get criticized, even though I'm right about this. The Fed just follows the two-year Treasury. And the two-year Treasury is down at 3.6. And so the Fed needs to cut rates 150 pretty quickly. And I think they're going to start with 50 tomorrow.
The banks can't agree either. Bank of America strategists have made their view clear. They think a half-point cut would not be justified, would be difficult to communicate, and could trigger a risk-off shock. But JP Morgan has come out on the other side of the fence, forecasting a 50 basis point cut, not just today, but at November's meeting too. That's severe conviction, isn't it, versus other participants?
Yeah. And look, we've got some great data that the team put together. Look at the CPI since the Fed last cut. Yeah, since it last cut. So that's, is that the one? Yeah, no. Is that where it is? Really? That looks interesting chart. I'm not sure that's the one I thought it was. But anyway, look, that's where the CPI is since the Fed last cut. Down from more than 9%. The 10-year yield, this is interesting as well, since the last cut as well. 3.642, but look at it since look at the middle of the screen is where I'm looking, or middle right. So you can see the Treasury yield has come off from roughly 5% to 3.642. And again, this is kind of the point I'm trying to make as well, is that if the mood music is right, if the expectations are right, well, on the mortgage front as well, look at this. The cost of your 30-year debt has gone down aggressively from nearly 8% to just over 6%.
Can I pick up on the Bank of America communication? Because I have a view on that too. The 50 basis point rate cut that comes through today, we were always schooled in the thought that this is a shock and awe type of policy, extraordinary sort of reaction to circumstances that are quickly moving away from the Fed. How on earth do you change that mindset today and communicate it as a potential insurance cut that the Fed just wants to take extra measures in case, so as it can avoid some sort of a dire landing? Because if you think about the next crisis when it comes, and there will be another crisis, as we know, after this at some point down the track, if it needs to go 50 and it is actually in crisis, how does it then communicate? Oh, it's not an insurance 50 basis point cut. It's a real insurance. It's a real 50 basis point cut. I mean, do you damage some of your own toolkit by taking a 50 basis point measure today if the economy is in good shape at this stage? Do you blunt some of those instruments?
I hear what you're saying. It's kind of, 25 would be steady as she goes. We're pretty confident in the economy. We're not too worried about the labour market as well. But as one of our guests pointed out, their focus has definitely switched from concern about inflation to concern about the labour market as well. And it's at the same time that the market concern has flipped as well. I got to be honest. I think I might be the only person watching this on Wall Street, in the market, if you're trading from home, that actually, I don't think if they get the communication right, it matters today whether it's 25 or 50. I really believe that if you get your communication right on the dot plot, signalling forward cuts to come as well, on your communication in the press conference from Jay Powell, I don't think it will have huge ramifications if they can get that bit right, whether it's 25 or 50, because as we've clearly seen in every one of these charts, something that you and I can't argue about is the cost of money has gone down aggressively.
Can I beg to differ with you slightly? Because I think that you've got a lot of complexity now coming, and that is thanks to the US election. We've had some guests on this week have been talking about it. Ultimately, you've got a Fed today that's not just setting policy around the data that it's looking at and trying to anticipate down the track. You've also got a Fed that's trying to anticipate what the election outcome it could be and what that data could do to the existing data it's looking at today and where it could be in future. So I think the communication is just one element. I think it's just got so many moving pieces, and it's going to be incredibly difficult for the Fed. I mean, we're looking at very different policies around Trump versus Harris, and what the Fed does with that, whether we're looking at an inflationary environment down the track again. I mean, if you're cutting by, say if you're a Fed, you think you need to cut by 50 basis points today, yet if it's a Trump presidency and if there's all sorts of tariffs going up at the border and it causes more inflation, does the 50 look like the wrong policy for a Trump administration, but does it look like the right policy for a Harris administration?
Let's get someone who's written the book on the central banks. Naomi Prinz is the founder of Prinsights Global. Lovely to see you. Naomi, we've just been pontificating for the best part of a quarter of an hour on what the Fed should do, shouldn't do, the ramifications of it, the language, the tautology that we can draw in a Greenspan-esque fashion from what he says. But what do you think, more importantly?
Well, I think he's going to do a tightrope. Look, until very recently, Federal Reserve Chairman Jerome Powell was talking about inflation needing to be under 2%. And then he started seeing the jobs figures in the United States. And yes, we're approaching an election. And yes, the economy is weakening as well on an inflation adjusted basis. So he has to do an about face, deal with the messaging of cutting rates, and also deal with telling the markets, whether he is actually physically concerned about it or not when he speaks, he actually is also in this election period, that everything's okay and they've got everything under control. And they're not late this time with respect to the economy slowing and the labor market slowing down like they were when they didn't notice that inflation was rising so quickly, and they called it a transitioning phase. So it's going to be very interesting, more the language than what the actual cut is, to see what happens. And it's also going to be interesting to see if they do anything with the pace of quantitative tightening, which they reduced a number of months ago in terms of that pace, because the banking system is facing problems as well. So all of that will be hanging in the balance.
Yeah, look, I hear what you're saying about the about face then, but look, there's no doubt about it. Unambiguously, the Fed, along with every other central bank, failed miserably to spot that inflation was more than transitory. And I know there's still some transitory economists out there who still think they were right. You were wrong, but there you go. But in terms of this term round, actually the Fed has done way better than the market because it's held its nerve on rates. It hasn't cut aggressively. And actually at the moment, the landing, whether there is a mild recession or no recession, the landing looks great for America compared with the rest of the world.
It does in some measures, but not necessarily if we look at what's brewing. If we look at an unemployment scenario that, even though last month sort of ticked down by a tenth, is in a trend upward period since the beginning of the year. And again, if we look at the U.S. banking system and the fact that there is still a significant amount of delinquencies and defaults coming into commercial loan books, hurting regional banks and so forth. So yes, on the outside, if we look at the overall economic figures, if we look at overall GDP, even adjusted for inflation, it hasn't really gone down. But that said, it's kind of flatlining. It just hasn't gone down. So I don't think it's so much a soft landing as a landing. And kind of remains to be determined whether the labor market continues to weaken. The last month reading is a little bit of a blip, that lower by 0.1%. And we are still looking at higher figures and other sorts of participation figures, along with unemployment and openings at rates that we haven't seen in the labor market since the preamble to the financial crisis. We don't really know that. So the Fed can declare a sort of victory, I think, with a medium economy. But there are brewing factors that I think remain to be determined, even though in other countries, the Bank of England cut rates first, the ECB cut rates first, Bank of Switzerland and so forth, National Bank of Switzerland and so forth. Yes, that has all happened before the Fed, and the Fed sort of stuck to its, really to Powell's stoicness regarding inflation and getting it down below 2%, which it isn't. And now having to face that anyway. And again, that's going to come into language tomorrow. But it's not clear that the economy, or certainly the labor part of the economy and the debt and consumer part of the economy, is going to stay level as opposed to actually declining, because rates were so high for so long comparatively over this period.
I hear you around the weakness in the data, and I think there is some ambiguity as to just what the economic picture looks like. Others are making a strong argument that the economy is intact. So what does the Fed do in that context? Because the 50 basis point reduction was always seen as this crisis era emergency response. If it uses that tool this time round, I was making the point before, does it destroy that tool for future use when it does actually have a genuine emergency happening?
That's a really interesting point. And when they have cut by that sort of significant amount, it's been around a financial crisis, it's been around a COVID crisis and so forth. And if they did do that, it would be preempting what I think is them seeing that there actually is more economic weakening. And again, certainly labor market and banking system weakening than meets the eye with the overall numbers. We've had an economy in the United States buoyed by the consumer, which is buoyed by effectively debt. And meanwhile, savings are being depleted. Deposits are running out of regional banks, especially if rates do get cut, because then there's less of a need for those deposits to stay there. And yes, they could go into the market, they could go into other places, they could go to pay bills, they could go to pay credit card bills. So again, there's weakness there. So if we were to see that, I think it would signify that the Fed is actually scared of what could happen in the economy. And that's one of the reasons why, if we did see a move that big, I think the language that accompanies that is going to be way more important than the cut itself. And if we see a more, sort of fencing the edges or just sort of a 25 basis point cut, then that's indicative of, look, other central banks have cut. We are seeing weakening conditions. We have this under control. We just want to kind of get ahead of it. And I think either way, that's going to be the messaging we're going to see, or that Powell's going to try to put forth.
Naomi, we spent a bit of the morning talking about getting from A to B, the metaphor of the bus, and whether it's getting away from the Fed. But there's another element here, and it's the US election and just what the destination looks like, whether it's going to be Trump or whether it's going to be Harris. We've so far heard from Powell in the last month or so saying we don't need to get back to 2% on inflation before we start cutting. But as we sit around, 2.5% on the headline PCE, 2.6% on the core, is there a prospect that we get steered off course on that lower direction we're getting on the inflation level because of the US election?
Yeah, there absolutely is. We could definitely see, we're seeing weakening in the dollar, which isn't necessarily inflationary, but that is an impact in the election. And we're also seeing uncertainty, or we see more uncertainty come into the election period. What we saw is that Congress is not able, and they're not really discussing a budget, and whatever that budget is going to have a significant deficit attached to it, and that's going to have political implications, which is pretty much why Congress really is deciding on anything and may in fact push forward decisions on the budget and so forth. We're in an election period. All this adds volatility to the system, not necessarily inflationary volatility, but certainly something that I think is going to be looked at by both sides. The White House wants to have an economic landing that is soft, that it wants the Fed to have gotten this right, because with less than 2 months to go before the election, it really doesn't want the economy to go off the rails. And the Fed doesn't want inflation to go off the rails. Anything can come in to impact inflation net of the election. We could have a major geopolitical event. We could have a major energy event. We could have major climate events. There are certain things that can still happen that can put an inflation bend upward on that 2.5%. That's why I think Powell ordinarily, if this perhaps wasn't an election period, the Fed is not supposed to be political. It wasn't created that way. Yes, its heads are appointed by the president, confirmed by Congress, but it's not supposed to care. But I don't think if it were just up to him in a vacuum, he would necessarily want rates to be reduced right now, even though we have a stagnating economy and we have a weakening labor market, because inflation isn't where it needs to be and there isn't enough of a cushion there. And actually, I think he can also, because of that, say that we will watch the data, as he likes to say, just in case inflation, does tick up for whatever the reasons. We will be more careful, in what is now an accommodated period in terms of rates.
It'd be fascinating to see what happens on Truth Social if they go 50 as well. I dread to think. Naomi, lovely to see you as ever. We'll look forward to seeing you in London again soon. Thank you so much as ever for joining us from LA. Naomi Prinz, who is the founder of Prinsights Global. And for more on what today's move could mean, not just for the US, but for the world, head to CNBC.com. Arabile.
Steve, coming up on the show, militant group Hezbollah accuses Israel of detonating handheld pages across Lebanon, killing at least 9 people. Have more on this developing story after the break. Plus, after weeks of negotiations, EU Commission President Ursula von der Leyen unveils her new top team. Who has she got? Well, we'll tell you all about those nominations, and don't miss our exclusive interview with the Novartis CEO, that's Vas Narasimhan, as the company gains expanded approval for a key cancer drug in the US. That's coming up at 6:30 BST.
Pages belonging to the militant group Hezbollah have blown up across Lebanon and some in Syria actually as well, seemingly simultaneously killing at least 9 people and injuring almost 3,000 more, with hundreds in critical condition. Hezbollah has blamed the blasts on Israel and vowed retaliation. Dan, it's absolutely an extraordinary story. A lot of people perhaps didn't even know that pages were still in use in the 21st century, but they were in use, of course, so that Hezbollah and others thought that they were less easy to infiltrate from, obviously, other security forces as well. But just tell us what's happened here and what the ramifications could be.
Well, Steve, you're exactly right. This appears to be a sophisticated and coordinated attack straight out of a Hollywood spy movie. What we know is that at least 9 people have been killed, almost 3,000 injured after these pagers, or beepers as they're also known, being worn by members of the militant Hezbollah group, suddenly exploded. And Hezbollah says basically it hands out these pages to its members in order to communicate with one another out of fear that normal mobile phones could be tracked and monitored. But extraordinary images captured on CCTV and shared on social media shows those devices exploding without warning and causing serious injury. Now, among those injured was Mojtaba Amani, that's Iran's ambassador to Lebanon. And in a post on X, his injuries were described as superficial. He is apparently in a good condition. But we're also seeing reports that Mohammed Mahdi, he's the son of a Hezbollah member of parliament, was killed. That's according to the state-run national news agency. Why is that important? Well, the apparent targeting of an ambassador and the death of an MP's son certainly raising the escalation risk as we see these tensions between Israel and Hezbollah continue to ratchet up as Israel's war in Gaza also rages on. What we also know is that the former CIA director, John Brennan, has told NBC News that he believes these pages has obviously some kind of explosive inside the hardware based just on the scale and simultaneous nature of the attack. But he also believes that these pages were at some point intercepted and switched before being delivered to those Hezbollah operatives. It's certainly a major security breach for Hezbollah if that's true. So, of course, the finger of blame now being pointed. Hezbollah certainly quick to blame Israel for the explosions without providing any evidence, and Israel has not claimed responsibility. And Lebanon's foreign ministry also called this an Israeli cyber attack and said it's going to submit a complaint about the detonations to the UN Security Council. So certainly a situation that raises the tensions in the region.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.